We often hear about this cat and mouse game in the stock market, right? This
Yeah.
idea that company managers are trying to, outsmart everyone, timing their moves perfectly,
Hmm.
issuing stock when it's high, maybe buying back when it seems low.
Mm-hmm. The classic market timing idea.
Exactly. But what if that's not like the main driver behind some of these patterns we see?
Hmm.
When companies decide to either raise cash or hand it back to shareholders.
That's really the heart of what makes this research so interesting. Today, we're diving into a study by Li, Livdan, and Zhang. They offer a really compelling neoclassical take on these financial puzzles.
Okay. Neoclassical, not just behavioral.
Right. Instead of focusing only on market timing and how investors might react or underreact, they use what's called a Q theory model. It digs into the fundamental economic reasons behind these actions.
Okay, Q theory model. That sounds pretty academic but intriguing.
Yeah.
So the mission for this deep dive is to really get our heads around the key insights from their research.
That's the plan. They've looked at a ton of data and built this model to explain some of these, well, seemingly odd behaviors in the market.
And what's the core idea they're putting forward?
Basically, they argue that these patterns we see, lower stock returns after a company raises capital, higher returns after they give cash back, are largely a result of companies just making the best possible investment decisions for their business.
Hmm. So it's less about trying to game the stock price.
Yeah, much less about that and more about the kind of nuts and bolts of investing in the company's future growth and operations.
Okay, so let's get right into it then. What are these external financing anomalies that have, puzzled researchers for so long? What exactly are we trying to explain here?
So the fundamental observation, the thing everyone notices, is pretty clear. When companies raise capital from outside sources, like selling new shares of stock,
Yep, equity issuance.
right, equity issuance, they tend to see lower average returns on their stock over the next, say, 3 to 5 years.
Lower returns after getting a big influx of cash.
Yeah.
That still feels a bit backwards to me. Wouldn't you expect that fresh capital would fuel growth and, lead to better returns?
You might think so, logically, but the data consistently points the other way. And then on the flip side,
Uh-huh.
companies that distribute capital back to investors, maybe through dividends, or by repurchasing their own stock.
Share buybacks.
Exactly. Those companies tend to experience higher average stock returns in the years following that distribution.
Okay, so raise money, stock tends to do worse later. Give money back, stock tends to do better. That's the anomaly in a nutshell.
That's the core puzzle.
And the common explanation, like we touched on, is this behavioral idea, market timing.
Precisely. The thinking goes that managers are savvy, right? They issue stock when they think their company is overvalued, taking advantage of what they see as an inflated price.
Makes sense from their perspective.
And conversely, when they feel their stock is cheap, maybe undervalued, they might use internal funds or even borrow money to invest, or crucially, to buy back shares.
Yeah.
And the behavioral part is the idea that investors then don't fully grasp these signals. They sort of underreact to what the company's financing decisions are telling them.
Right, that makes a certain intuitive sense. Managers know more, they act, investors are slow. But now we're bringing in this Q theory model. What's the key difference? You said neoclassical perspective.
Well, the Q theory model offers a different lens. Instead of primarily focusing on investor psychology or market efficiency issues, it zooms right in on the fundamental economic factors driving the company's actions, especially its investment choices.
So the company's decisions, not just the market's reaction.
Exactly. And what's fascinating is that this one model can simultaneously explain several of these key patterns. Patterns often blamed solely on that behavioral market timing story. It views company behavior as fundamentally rational, trying to maximize long-term value.
So it's trying to explain these market quirks through solid economic principles guiding company decisions, not investor sentiment.
That's the core idea. And the research dives into several specific predictions that kind of fall out of this model. And then they check, does the real-world data actually back these up?
All right, let's get into those predictions. What's the first thing this model helps us understand about, say, when companies decide to issue stock?
Okay, first key prediction. Equity issuance tends to be pro-cyclical.
Pro-cyclical, meaning
Companies are more likely to issue new stock when the economy is doing well during expansions.
okay. And does that match reality?
Yes, it actually lines up pretty well with what we see happening in the real world.
Yeah, that does make intuitive sense, actually.
Yeah.
Economy's strong, companies see more growth opportunities, maybe need more capital from them.
Exactly right. Now, the second prediction gets a bit more involved. It looks at the relationship between how much a company invests in its business and how its stock performs later.
Investment levels and future returns.
Okay. The model predicts a negative relationship here.
Negative.
Yeah.
So, more investment.
Tends to lead to lower stock returns down the road. And interestingly, it also suggests this effect is even stronger for companies that have a lot of cash flow already.
Wait, so if a company has lots of cash and invests heavily, the model says expect even lower returns. That's definitely not what most investors would instinctively think.
No, it really goes against that common intuition, doesn't it? But there's actual data supporting this negative link. The study points to research by Titman, Wee, and Shi from 2004 that shows exactly this pattern in the market data.
Wow, okay. And how well does the model's prediction actually line up with those real numbers? Is it close?
Well, the researchers found the model does a pretty decent job capturing the effect, but maybe not its full strength.
How so?
For example, they look at the difference in returns between companies that invest a lot versus those that invest very little. They call it the CI spread. The model predicts an average annual difference of about 10.1%.
Okay.
But the real-world data shows a bigger gap, around 16.9%. So the model gets the direction, right negative relationship, but underestimates the magnitude a bit.
Got it. Still, capturing the direction is significant. So the model says more investment, lower returns. What are the underlying economic forces in the model that lead to this? Why does it predict that?
There are two main forces or channels at work in the model. The first is what they call the cash flow channel.
Cash flow channel.
It
Okay.
incorporates the idea of decreasing returns to scale. Think of it like this. As a company invests more and more and its base of assets grows, the extra output or profit it gets from each new dollar invested tends to get smaller over time.
The law of diminishing returns, basically, at the company level.
Exactly. So this leads to a lower marginal product of capital, less bang for your buck on the next investment, and as a result, lower expected future returns.
Okay, that makes sense. What's the second channel?
The second is the discount rate channel. This relates to the costs a company faces when it changes its level of capital, like building a new factory or buying major equipment.
Adjustment cost.
Right, capital adjustment costs. Because of these costs, the model implies that companies are more likely to invest heavily only when their marginal Q is high.
Marginal Q. Remind me what that is.
Think of marginal Q as the management's internal calculation, the net present value of future cash flows they expect from one extra unit of capital. Basically, is this next investment worth it?
Okay, so they invest when marginal Q is high. How does that link to discount rates?
Well, a high marginal Q often happens when the required rate of return investors demand the discount rate is low. So seeing a company invest heavily can be a signal that discount rates are currently low.
And if discount rates are low now?
That implies lower expected returns going forward.
Wow. Okay, so high investment can signal both potentially lower profitability from those new investments due to diminishing returns and a lower required rate of return from investors currently. That's a really different perspective than just, oh, the stock must be overvalued.
It is. It frames the company's actions in terms of optimal responses to economic conditions and opportunities.
Okay, so what's the next piece of the puzzle the model helps us understand?
Well, it also directly addresses that long-term underperformance after companies issue new stock. Remember Loughran and Ritter's famous finding from '95?
Yeah, the post-issue blues.
Exactly. The model actually reproduces this pattern. It shows that companies issuing equity tend to perform worse than similar companies that didn't issue stock over the long run.
And how do the model's numbers compare to the real data on that underperformance?
It's pretty interesting. The model predicts an underperformance of about minus 0.81% per month, just based on whether a company issued stock or not.
Okay. And the real data?
The actual data shows something like minus 0.49% per month. So in this case, the model captures the negative trend, the underperformance, and maybe even slightly overestimates its size.
Interesting. So it gets the effect, maybe even exaggerates a little.
Yeah.
Does the model also explain when this underperformance might be worse?
Yes, it does. It aligns with the finding that this underperformance is more significant following periods where there's just a lot of equity issuance happening across the whole market, like during hot issue market.
Yeah. That fits with the behavioral idea too, right?
Yeah.
Maybe during market booms, more companies are issuing potentially overvalued stock, leading to a bigger eventual letdown.
That's one interpretation, certainly, but the model gets there through its own logic. based on fundamentals and investment cycles. Now, the model also looks at the operating performance of these companies.
Oh, okay. Not just the stock price, but how the actual business is doing. What does it tell us there? We often hear that companies issue stock when they're doing really well, right? Peak performance.
Exactly. And Lofgren and Ritter found that too back in 97. Companies issuing stock tend to show improved operating performance before the offering,
Right.
but then their performance tends to deteriorate afterwards.
Okay. Does the Q theory model capture that rise and fall?
It mirrors that pattern, yes. The model's explanation relies on the idea of firm-specific productivity shocks. Unexpected good things happening for that specific company.
Like a new product hitting big or costs falling unexpectedly?
Sort of, but the key is that these shocks tend to be mean reverting. They don't last forever. So companies that have recently had positive productivity surprises are more likely to invest, and they might choose to issue equity to fund that investment.
All right.
But because those positive shocks are usually temporary, they tend to fade away, and that leads to the observed decline in operating performance after the stock issuance.
So they might be issuing stock on the back of a temporary high, but that underlying good fortune doesn't necessarily persist. Makes sense. What about the other side then? Companies returning cash.
Right, cash distributions. The model predicts that companies distributing cash dividends or buybacks will tend to outperform similar companies in the future.
Okay, matching the other half of the original puzzle.
Yes, this is the finding documented by Eikenberry, Lakonishok, and Vermeulen back in 95. Giving cash back is associated with better future returns.
So the model gets that too. How strong is the effect in the model compared to reality for this one? You said the investment effect was a bit weaker in the model?
Yeah, it's somewhat similar here. While the model does show this positive drift in returns for cash distributing firms, the magnitude of the outperformance is generally smaller than what's observed in the actual market beta.
So directionally correct again, but maybe not capturing the full punch.
Pretty much. But it does capture another interesting nuance.
Oh, yeah.
In both the model and the real market data, this outperformance after distributing cash is stronger for value companies.
Value firms, like low praise to book.
Exactly. Those tend to see a bigger boost after distributions compared to growth companies.
Huh. That's a classic value investing observation. It's fascinating that this model focused on investment can also explain that detail. What about specifically share buybacks? Does it look at their operating performance?
It does. The model aligns with findings from Lie in 2005. Companies announcing share repurchases tend to have better operating performance than their industry peers before the announcement.
So they're already doing well.
Yes, but then, similar to the equity issuers, this superior performance tends to weaken after the repurchase announcement.
So again, maybe buying back shares when things are good, but that peak performance might be mean reverting.
That's the logic within the model, yes. Those productivity shocks returning to average levels seem to play a role on both sides, issuance and distribution.
Okay, so this model seems to do a remarkably good job explaining a lot of these long-standing market anomalies just through the lens of optimal investment decisions. But where does risk fit into all this?
That's a great question. The model actually provides some interesting insights there, too. It shows that smaller firms, smaller in terms of their physical assets, not just market cap, tend to be inherently riskier.
Riskier. Why?
They call it the physical size effect. It stems from those decreasing returns to scale we talked about. Smaller firms are further away from hitting those limits, so their outcomes might be more variable.
Interesting. A different kind of size effect.
Yeah. And the model also suggests that a company's level of investment is negatively related to its risk.
Wait, high investment, lower returns, and also lower risk, according to the model.
That's the relationship that emerges from the model's mechanics, yes.
That has got to have implications for things like the CAPM, right? The capital asset pricing model.
Absolutely. The researchers make a really important point here. They argue that even though their model is fundamentally consistent with a conditional CAPM meaning, the CAPM holds at any given point in time if you have all the right info.
Okay.
Standard ways of testing the CAPM in the real world might still lead us to reject it.
Why would that happen if the underlying reality fits the CAPM?
Well, a couple of reasons. First, it's just really hard to get precise measurements of a stock's beta, its sensitivity to market movements. Our estimates are noisy.
True. Beta calculations can vary a lot.
And second, the actual relationship between risk and return in the model isn't a simple straight line. It can be non-linear. Standard tests often assume linearity.
So the CAPM might look broken in the data, but it could just be that our testing methods aren't sophisticated enough or our inputs are too messy. at least according to this model's world?
That's a key insight they draw. In fact, they did a test when they used the true betas generated within their model world instead of estimated betas from market data.
Yeah.
Those investment characteristics, the CI factor, became much less significant in explaining returns. This really suggests that maybe some of the perceived failures of the CAPM in empirical tests could be due to these measurement and testing limitations.
Wow, that is a very different perspective than just saying the CEPM is dead. Okay, so how does all this stack up against those traditional behavioral explanations we started with? Does this Q theory approach invalidate them?
Well, the researchers acknowledge the behavioral market timing theory, definitely. But they also point out some, let's say, inconsistencies in the real-world data that this neoclassical model might handle more effectively.
Like what?
For instance, sometimes you see positive, immediate stock price reactions to announcements of private placements of equity, but these are also typically followed by negative long-term performance, just like public equity issues.
So why the positive pop at the announcement?
It's a bit hard to square that immediate positive reaction with the simple idea of investors just slowly underreacting to a negative signal from management.
Right. If it's bad news, management's selling high, why would the price jump up initially?
Exactly. The model here suggests maybe short-term price moves are driven by different things, perhaps asymmetric information, where some informed investors react quickly while the long-term drift is more fundamentally tied to these investment-related expected returns we've been discussing.
So it sounds like the full picture is likely more complex. Maybe it's not just managers timing the market and investors slowly catching on.
Precisely. The Q-theory model offers this really compelling argument that fundamental investment decisions, driven by economics, play a huge, significant role in shaping these patterns in returns and financing choices.
Okay, so let's try to bring this all together. What's the main takeaway for someone listening to our deep dive into this research?
I think the central insight is that a company's investment decisions driven by core economic factors like diminishing returns, the costs of changing capital levels, are a major reason, maybe the primary reason, why companies that raise money tend to underperform later and why those that return cash tend to outperform.
So it gives us this powerful alternative lens, right? Moving beyond just thinking about managers trying to game the market at every turn.
Yeah, it's like the market over the long run is reacting more to the underlying investment strategy and the economic logic behind it, rather than just the financing transaction itself.
That makes a lot of sense. Now, you mentioned the model doesn't capture everything perfectly.
Right. And it's important to remember that. While the Q-theory model does a, frankly, remarkable job explaining many of these puzzles simultaneously, it's a starting point.
Yeah.
The researchers themselves point out areas for development like it doesn't fully capture the magnitude of the outperformance after cash distributions, as we discussed.
And did they suggest where future research might go from here?
They did. They suggest things like incorporating a more detailed model of payout policy, like how do companies choose between dividends and buybacks specifically, and what are the costs involved in distributing that cash?
Okay. The dividend versus buyback decision itself.
Exactly. And also bringing debt financing more formally into the model. That could help us better understand things like how well we can predict overall market returns based on aggregate equity issuance, or why the long-term performance differs between companies issuing stock versus those taking on debt.
So still plenty more to explore and refine in this area. It's clearly a complex picture. All right, so maybe to leave you, the listener, thinking. When a company announces a big new investment plan or maybe a substantial share buyback program, perhaps our first thought shouldn't just be about whether the stock seems overvalued or undervalued right now. Maybe the more important signal is hidden in what those decisions tell us about the company's long-term strategy, how they see their future opportunities, and the fundamental economic landscape they're navigating. It's about the long game, perhaps, not just trying to catch a short-term market swing.